You've seen the headlines about the new Denver Broncos stadium at Burnham Yards. The team owners are emphasizing that the stadium itself will be privately funded. That sounds great for the city, but there is a major catch that most people are overlooking. While the billionaires pay for the glass and the turf, the surrounding public infrastructure is a completely different story. We are talking about billions in roads, expanded sewers, transit hubs are required to make that district function. These are often funded through your property taxes. While everyone is distracted with the stadium, Denver homeowners are opening their 2026 tax statements and seeing increases of 13% to as much as 40%. The confusing part is that your actual home value did not go up at all in the last year. This is the definition of sticker shock. Today, we are looking at the math behind the $20 billion fiscal trajectory of Denver. I'm Jeremy Kane, and here we are going to go deep into why your value stayed flat and why your bill went up. We're also unpacking the home rule loophole that left Denver residents uniquely exposed. If you are interested in where you sit right now for your home value, please click the QR code right here or check the link in the bio and we'll make sure that we get that over to you. Before we dive deep into the data, I need to clear up a timeline because we are sitting here in May in Colorado, 2026. Colorado is a pay-in-arrears state. This means the bill you received this past February and likely just finished paying was actually for the 2025 tax year. If you're feeling that bill shock right now or the sticker shock, it is because the 2025 assessment, it was already done. We already had the chance to contest it. The liability you are accruing while you watch this video in May of 2026 is your next year's tax bill. You will not see that statement until February of 2027. Why does this matter? Because 2026 is an intervening year. Your valuation is technically frozen at the level established in 2025. And if you did click that QR code and these values, along with these tax hikes, are making you decide whether to stay or go, let's have a conversation. Reach out to me, 303-210-0378. But let's get into this intervening year mystery that we are seeing here in Colorado. So we operate under a strict 2-year reassessment cycle. Odd number years are when your value is calculated based on the 24-month look back. The 2025 bill you just paid was based on the market data from July 2022 through June of 2024. Because 2026 is that intervening year, your market value is frozen. So why did your bill jump? It comes down to the expiration of the temporary state buffers. When values spiked after the pandemic, the state gave us a temporary $55,000 reduction on taxable value. That buffer is gone. At the same time, the baseline assessment rates for schools were cranked up to 7.15%. You are now being taxed on 100% of your home equity at a higher percentage rate. This was a calculated move by the state to capture the projected $20 billion in revenue windfall. The Denver home loophole. This is the part that specifically impacts my Denver viewers. While the state legislature passed bills to cap property tax revenue growth at 5.25% annually, those caps do not apply to everyone. Denver is a consolidated home rule jurisdiction. This constitutional status affords the city broad autonomy over taxation, meaning they're categorically exempt from those state growth caps. Denver is currently navigating a $200 million structural deficit within the $1.66 billion operating budget. Sales tax revenue has underperformed, forcing the city to rely more heavily on your property taxes to backfill that gap. Your tax dollars are literally the lifeline for a municipal apparatus facing insolvency. While your neighbors in non-home rule counties might get tax credits when the value spikes, Denver residents are essentially serving as the city's emergency fund. And then you walk out your door, you drive down the highway, and you see all kinds of massive projects, dirt moving, and the future liabilities we have to talk about. How this physical change in the city will impact your future taxes. Denver is undergoing a massive $20 billion facelift. These projects are high-value content acres, but for a homeowner, they're future tax triggers. Let's consider the National Western Stock Show. This is a 250-acre transformation in Globeville. It is driving gentrification and land values in the area, that were historically industrial. The River Mile, which we've talked about on this channel before, the project is replacing Elitch Gardens with a high-density luxury neighborhood. It completely redefines the downtown skyline. Next, we have the DIA terminal overhaul, a $2.1 billion expansion, turning the airport corridor into an aerotropolis. This drives corporate relocations and residential demand. Wonder what's really going into the $20 billion facelift in Denver? Go check out my first video on this channel. It's all about the $20 billion infusion into the downtown areas around the sports fields and a couple that are on the outskirts. Go check that out because we have to understand the macro level changes before we talk about your neighborhood equity and your taxes and everything that impacts it. So let us get into some perspective. Even with these spikes, Colorado still has some of the lowest property taxes in the nation at roughly 0.48%. If you move to Texas, escape these hikes, you will likely pay double or triple in the taxes for a similarly priced home. However, Colorado certainly finds other ways to get their money. If you have registered for a new car here recently, you know our license plate fees can feel almost like a monthly mortgage payment. You save on the home asset, but you pay for the Subaru. It is a trade-off that highlights why your home is an asset that must be managed strategically rather than set it and forget it investment. But some of these taxes are absolutely things that we have to stay on top of and we have to be aware of, because ultimately a higher taxed bracket because of a build or something like that may mean a harder home to sell down the road. So do not fall for the state deferral program trap. Deferring your taxes sounds helpful for cash flow, but it creates a government lien on your equity that accrues interest. It is essentially a reverse mortgage that erodes your wealth over time. This is especially dangerous for retirees on a fixed income. A home is an asset to manage well, and the transaction is just the beginning. If you are feeling the squeeze of the 2026 tax assessments, we need to talk. Reach out to me to schedule an annual equity review, and we can start there. We will run the math on your specific property and build a tailored wealth strategy that fits your actual life and your lifestyle, so we know what we're starting with. So start there. Start with the CMA tool. Let's hang out. Go check out that downtown $20 billion downtown video because it has a lot of information in there. And for now, let's continue to help you build your wealth through real estate. Thanks so much for tuning in to What's Happening in Denver. We'll see you next time.